Okay, so let's continue. So now we're going to look at a concept called the average return, or the historical average return, or the arithmetic return. How do you calculate a historical average return? Well, it's the sum of the yearly returns divided by the number of years. So the historical average return is equal to the sum of the yearly returns divided by the number of years. So this right here is a summation. So let's say you have 10 years, then you would have 10 annual returns. You add up all 10 returns, and then you divide it by 10. Okay? So let's look at the average return. For large company stocks, the average return has been 11.7%. For small company stocks, it's been 17.5%. Corporate bonds, 6.6%. Long-term government bonds, 6.2%. U.S. Treasury bills, 3.7%. And inflation, 3.1%. So notice that small stocks have a higher return, and it's because they have a higher risk. Corporate bonds have higher return because they have a higher risk than the government. It's important to note that, remember that bonds are actually loans. Okay, so basically a bond is a loan. In this case, a corporate bond is a loan to a corporation. A government bond is a loan to the government. Okay, a U.S. Treasury bill is also a loan to the government if it's a short-term loan. Okay, so what do stock markets look like around the world? The United States is the largest stock market in the world by capitalization, or market capitalization. Market capitalization is the price per share multiplied by the numbers of shares. Okay, so it's kind of like the value of the equity out there. The U.S. stock market in 2011 was worth $15.6 trillion. Okay, in 2011 it was worth $15.6 trillion. The Canadian one was worth $1.9 trillion. So I guess one important way is to gauge how big the stock market is relative to its economy, its GDP. The United States is roughly, the stock market capitalization is roughly the size of the U.S. economy. So back then, the U.S. economy, the gross domestic product was close to $15 trillion, and we had roughly $15 trillion in stock market capitalization. That same relationship doesn't hold exactly for other countries. Other countries have more market capitalization relative to their GDPs. Total stock market capitalization in the world, according to this graph, was $47.4 trillion. And roughly 33% of the stock value out there was traded in the United States. Okay, so an important concept to understand is what we call the risk premium. The risk premium is the difference between the actual return minus the risk-free rate. So the average return for large stocks minus the 3.7 right here should give you the 8%. So it's the return on the portfolio minus the risk-free rate gives you the risk premium. So 11.7% minus 3.7 gives you 8%. That is the risk premium. And the risk premium is what investors are willing to pay you to take on risk. The greater the risk premium, the greater the expected return. That's the idea. So notice that the risk premium for stocks is 8%. Versus small stocks, it's 13.8%. And for bonds, it's 2.9%. Long-term government bonds, it's 2.5%. And of course, the risk premium for the U.S. Treasury bill is 0. Why is it 0? Because it's the U.S. Treasury bill return minus the U.S. Treasury bill return gives you 0. Okay, so the risk-free rate is the return on a riskless certain investment. Okay, so what is a risk-free investment? A risk-free investment is an investment where you lend your money to someone or you give your money to someone and you're sure to get it back, like you have to get it back. There's no risk involved. There aren't many risk-free assets out there, but one proxy for risk-free assets is the U.S. Treasury bill return. You can use the 90-day U.S. Treasury bill return to get an idea of what the risk-free rate is. The risk premium, like I said, is it's the return on a portfolio minus the risk-free rate. So it's how much people are getting paid for bearing risk. Okay, that's why it says reward for bearing risk. Okay, let's see what's next. Okay, so the second lesson, the greater the potential to reward, the greater the risk. Yeah. Okay, so how do you measure risk? Usually you measure risk using standard deviation. Standard deviation is a similar concept to variance or variability. That's how we usually measure risk. So we'll look at this second concept in another video.